managers. I'm ASEEM Kumar. I'll be just giving you the outline what we have covered till 14th May. Block 1, accounting and overview. We have discussed about the introduction to accounting, preparation of books of accounting, financial statements, preparation of final accounts of companies, and cash flow statement of this block. Thereafter, we have discussed cost accounting, the understanding and classifying cost, absorption and marginal costing, and finally, Unit 8, the activity-based counting of Block 2. In Block 3, in the application of cost accounting, we have discussed cost volume profit analysis, budgeting and budgetary control, and variance analysis in the shape of Unit 11. Out of Block 4, in the last session, we have discussed the understanding of annual reports under the head Financial Statement Analysis. Since it is the last session of MMPC004, we are going to discuss 2 units of Block 4 and the remaining 2 units are from Block 5. So in the financial statement analysis, we are going to discuss about the comparative, common size and trend statements, followed by the ratio analysis. In Block 5, on the title Emerging Issues in Accounting, we are going to discuss the human resource accounting and forensic accounting respectively. Friends, once we know that we have finished our annual accounts, we have the basis based on which we can assess, we can judge, we can calculate the financial health of the organization. So, what are those tools? What are those calculations? What are those ways and means procedures by which we can calculate the financial health of an organization? The first one is in the unit number 13, we are going to discuss about the ratio analysis. Ratio, mathematically, if we are just known to, that ratio is a sort of, say, the balance or the relation being given for 2 different components. So, types of financial ratios we have: profitability ratios, liquidity ratios, leverage ratios, coverage ratios, efficiency ratios, and valuation ratios. Friends, when we are just to know about what is our profitability, then we have to just take out the component which are of profit and loss account, trading account, respectively. So the first one is gross profit margin. What we do? We are reducing the cost of goods sold out of sales, that is gross profit, and it is divided or compared by the sales revenue. So what we get? We get the gross profit ratio, the gross profit margin, the comparability of sales revenue and the gross profit. Next, once we are in know of the gross profit, we can also calculate the net profit margin. For calculating the net profit margin, what we have to do? The profit after taxes or net profit. Okay? Net profit. So net profit divided by the sales revenue. So we are in a position to get how much net profit we have earned in the last financial year, thereby giving you an outlook, a kind of status that how much grossly you have earned and how much net profit you have, so that at least you can just think of the growth of that domain. Net operating profit margin. Now operating profit, there is a difference between the net profit and operating profit. Friends, when we are just talking about the operating profit, it is mainly related to the operations of a business. Operations of the business. So it is net operating profit after tax, or 1 minus tax rate divided by the sales revenue. So you will be in a position to know what that from the main business of the organization, how much net profit percentage you have on your sales. This is the other calculation which we are going to do. This is EBITDA margin. Now what is EBITDA? It is earning before interest, taxes, depreciation and amortization. Friends, when we just talk about the interest, it is the financial expenditure. When we talk about the taxes, these are the financial expenditure. But when we are just talking about the depreciation, it is symbolic but calculated and presented therein the profit and loss account. And the same thing for the amortization, that the expenditure we have incurred, now we are just charging it to the profit and loss account. So EBITDA divided by sales revenue. So we come to know about that how much cash profits we have earned, and this profit, how much percentage it constitute of the sales revenue. We have return on invested assets. Return on assets. We have to just know about that how much assets we have and how much return we are just getting it. It is just to know about your financial health of the other domain. So NOPAT, it is net operating profit after tax, 1 minus tax rate divided by the total assets. And in a similar way, when we are just calculating about that the asset we have just seen to, we have to calculate on the capital employed as well. Return on capital employed. Return on capital employed. So return on the capital employed, ROCE. Then what we do? It has got two different domain. One, the net operating profit, which is your business profit, apart from the other income you have, would be 1 minus tax rate divided by total debts and shareholder funds. This is about the operating part. But when we are just talking about the net profit, inclusive your other income also, earning before interest and taxes. Return on capital employed, the other domain would be earning before interest and taxes. It is divided by the total debts plus shareholder funds. Return on equity. Now, the owner of the company, they would like to know about that how much profit we have earned, which would be eligible for distribution of dividend. This is one such thing you can just think of. The investors, the shareholders, the owner of the company would like to know about that how much percentage of profit they have their shareholders funds, the final result after payment of interest and taxes. So return on equity, it is profit after taxes divided by the shareholder funds. You come to know about the profit percentage on your shareholder funds. Earning per share. Now here comes the total profit is not being distributed as dividend to the shareholders. Means there are certain profit appropriation accounts also where you are transferring a fixed amount to the general reserve, to the contingencies reserve, to the other designated reserves. So profit after taxes divided by number of equity share outstanding. Okay. number of equity shares outstanding. Okay. Now this is profit after taxes. This is one thing which we are just calculating the other income. You are calculating the profit after taxes, interest and taxes, the total profit, net profit, I would say, and then divided by the number of equity share outstanding. But I told you that out of this profit, there are certain reserves. Reserves will be just transferring to. So, in the profit and say loss appropriation account, we get the provision for dividend at last. So, dividend per share. That was earning per share. Now it is dividend per share, which is the actual income of a shareholder. So, the total dividend divided by the equity share outstanding. Okay. Dividend payout ratio. Dividend payout ratio. Okay. How much profits you have after tax and how much dividend you have declared. What is the percentage of this dividend? Okay. What is the percentage of this dividend? So you can just find it out, dividend per share divided by earning per share. Yes, you can think of like that also. Dividend yield, dividend per share, market price per share. Now this is the yield when we are just taking the pragmatic approach, not the actual conservative approach. You are taking the market price of the share when you are coming the field, and then dividend per share divided by the market price per share of that company. So you get to know about how much dividend you have earned on the investment made by you in the equity shares. Earning yield, it is earning per share divided by the market price per share. So you come to know about that how much earning you have on the total market price, how much dividend you have got on your market price share amount. Friends, once we are just to know about the liquidity part, it is pertaining to the assets and liabilities. Mostly all those assets which are current assets, mostly those liabilities which are the current one. So in the liquidity ratios, we are going to discuss the first, the current ratio. It is being calculated by current assets divided by the current liabilities. Out of the current assets, there are certain components like inventory which cannot be sold outrightly or immediately. So out of the current assets also, once we just reduce the inventory, we get to know about the liquid assets, the quick assets, liquid assets or the quick assets. So current assets minus inventory divided by the current liability is the quick ratio. For the current ratio, the standard is 2:1, yet your current asset should be 2 and your current liabilities should be 1. Whereas quick ratio, the standard is that it should be 1:1. The current assets minus inventory, the quick asset should be 1 and current liabilities should also be 1. Cash ratio, cash and bank and short-term investment. Again, out of the quick ratios, you have reduced the debtors. You have taken only the cash, bank balances and short-term investments. You can just calculate the cash ratio. Quick ratio means it is better than current ratio, but cash ratio, it is as if you have cash in hand. So that ratio is calculated by cash, bank balance and short-term investments divided by current liabilities. Net working capital ratio. Net working capital, how do you calculate? How you just arrive at the working capital? The current assets minus current liabilities is equal to net working capital of the organization. So it is calculated Net working capital divided by net assets. Divided by net assets. Leverage ratios. Debt equity ratio. Debt equity ratio. Now we have to just focus on long term debts bearing interest bearing debts. So long term interest bearing debt means there are certain loans, there are certain say advances given to you, which is more than 1 year, maybe it is less than 3 years, but then if it is more than 3 years, it is just coming out to be the long term interest bearing debt and divided by the shareholder funds, equity shares. So we get to know about debt equity ratio. Debt ratio. Debt ratio means long-term interest-bearing debt and then long-term interest-bearing debt plus shareholder. That means the total long-term liabilities. So you just get to know about how much debt you have out of the total liabilities, long-term liabilities of the company. In the debt ratio, you just come to know about that how much outside funds are there in the long-term liabilities. Coverage ratio. Now, how you just cover your expenditure? Because in the matching concept, what we do, we set off the expenditure against the revenue earned. So the coverage ratio, interest coverage ratio, earning before interest and taxes divided by interest. How much we have? Okay, how much we have? Do we cover the interest? If not, that means the financial health is not good. If it is covering the interest, well and good. It should cover your interest income because that you have to pay to the outsiders. And there is absolutely no mercy. Even if you are incurring losses, you have to pay that. So interest coverage ratio gives you an idea that yes, you have earned some profit and thereby you are in a position to cover your interest expenditure. Debt service coverage ratio, DSCR. Once again, it is earning before interest, taxes, depreciation, amortization. Okay, so basically it is just coming out to be the net profit before this, say, non-cash expenditure divided by post-tax interest and lease rentals plus principal repayment plus preference dividends. Okay, so once you are just dividing this interest, you are in a position to know what, whether you can just take out the interest coverage, lease rental, principal repayment and preference dividend. Okay, if this is possible, these are certain expenditure which are once again not less than interest, yet having some mild conditions, but you have to pay that. You can extend it in the special circumstances, but on an average you are supposed to pay this on time. Efficiency. Now how efficient you are, how efficient you are, how much money you are blocking in your assets, whether you have cash ratio strong or the other efficiency bars are covered or not. So the inventory turnover ratio, cost of goods sold, okay, divided by or sales divided by average inventory. How you just calculate the average inventory? The opening stock plus closing stock divided by 2. Work in progress inventory turnover ratio, cost of production, we have just discussed about in the, say, costing part. Cost of production, when we are not adding the selling and distribution expenses, administrative expenses. So it is called cost of production. So once we are just adding the cost of administrative expenses, we get the cost of production. And once we add sales and distribution expenses in that, it becomes cost of sales. So cost of production divided by average work in progress inventory. Okay. So you come to know about that how much you are having pending in the factory in the shape of work in progress. Raw material inventory turnover ratio, cost of material consumed, it will be there in manufacturing account, and average raw material inventory, once again the opening stock plus closing stock divided by 2. Debtor turnover ratio. Friends, when we are just making the cash sale, we are bound to just give as per terms, conditions, or maybe because of the goodwill of the other people, we are to sell the goods on credit as well. So once we are just selling the goods on credit, the cash sale over because there is no debtor. But once it is a credit sale, we need to know about that how much credit sale we have and how much average debtors we have. So average debtor we just come to know about by opening balance, closing balance divided by 2, the average debtors, and credit sale is divided by this average debtors. To know about the debtor turnover ratio. Average collection period. Now this is important for the monitoring purposes. This is important for the monitoring purposes. You just come to know what in how many days you collect your average debts. So how you just calculate it, average collection period 365 divided by debtor turnover ratio. Okay, how you get it? Average debtors oblique credit days multiplied by 365. Okay, similar way when you are just looking at the average collection period of debtors, you have to calculate about the creditor part also, because they are also looking at you and thinking that in such and such time limit agreed by you, you will make the payment to them. Okay. So in that, I think there is something. Yes. Creditor turnover ratio, instead of credit sale, it should be credit purchase divided by the average creditors. Okay. And like that, you just come to know what that whether how much time you just take it. So this ratio is of course not covered in this particular block, but once again we can just say 365 divided by the creditor turnover ratio, so that at least the total pay period you will be knowing about. Net assets turnover ratio, sales divided by the net assets. So you come to know about that whether the sales are more than net assets or the sales are less than the net assets. You have to just monitor how to moderate the net assets and how to increase the sales. Investment ratios or valuation ratios. Price to earning ratio. Market price of equity share, earning per share. Now it is just the reverse which we have discussed earlier. Now is the investment part. That once you are investing somewhere, investment, you invested, you come to know about by this way that how much is the price and how much is the earning per share. So you come to know whether the investment is okay or otherwise. Okay. Market to book ratio, market value of the per equity share and book value per equity share. That could be only a pragmatic approach, because we are taking the conservative approach in the accounts and taking only the book value as per say purchase price, but market value you can calculate whatever is there prevalent in the market. So market value per share divided by book value per share of equity share. EV to EBITDA, enterprise value, the total value of the business, and divided by earning before interest, tax, depreciation, amortization. So you come to know what that how much you are earning on the total value of the business. Is it lucrative? Is it average? It is super average. It is excellent. Is it coming out to be bad? It is coming out to be normal or otherwise. Friends, with this we have completed our unit number 13, and now we are just going to have unit 14, comparative common size and trend statement. With the comparative statement analysis, a common approach to study the changes in the financial performance of a firm is to simply compare the financial statement for at least 2 years, because comparison, definitely you need at least data of 2 years, and calculate the changes between the 2 years. Such an analysis is called comparative statement analysis. So you compare 2023-4 with the 2022-23, it would be a sort of comparative statement analysis. You come to know about where you have reduced, where you have increased or developed, or growth is being reflected. Common size analysis. It is a statement when the common factors you are just writing at one place in the particulars, and then for n number of years, it could be 2 years, 3 years, 4 years, 5. So financial statement is by preparing the common size statement, thereby you come to know about the percentage of total assets or total liabilities. Once we just come to know about the comparative, once we come to know about the common size statement, we just get the trend. In what trend our assets are going, what is the trend of our liabilities, what are the trends of fixed liabilities or the current liabilities. So another important technique of analyzing the financial statement is to examine them over a period of time, say over 5 years. So once you just say make a sort of statement for 5 years, you come to know about what is the trend over the years, especially in items of income statement like sales, profit, items of balance sheet like net worth, debt, in order to undertake such trend analysis. Once we are knowing about our financial health, and we have 2 firms, 3 firms, 4 firms, or as a group, so you come to know about that, okay, let me just say compare the firm of a similar kind with the other firm things. So inter-firm analysis. Suppose you are manufacturing steel. So if you are having 2 branches or 2 different units, independent accounting units, so you can discuss about the inter-firm analysis. Besides investigating the financial statement of the company in question, analysts also compare the financial performance of the firm with its close. Close means your group member, close competitors, or the industry averages. Sometimes you do it with your own group. Sometimes you just come out with a close competitor of the same product or the industry averages. So what is the average industry? Say, talk about, and then you just compare it whether you are on the progression or it is just coming out to be reduction. Such an analysis is referred to as interfirm analysis or cross-sectional analysis, which enables the analyst to compare the firm's performance with its competitive or industry average. Friends, one Durant, one of the management scientists, he had just given his own analysis that how you just get it. I mean, it is just say prevalent. We have already discussed certain ratios. So return on equity, ROE, profit after taxes divided by equity. Okay. ROE, how you just calculate profit after taxes, oblique net sales, net margin, asset turnover, net sales oblique total assets. And then total assets divided by equity, equity multiplier. So you just come to know what profit after taxes divided by equity. What is your return on equity? Now we are just going to discuss block 5 and starting with the unit 15 under the title of emerging issues in accounting. The first topic of this particular block is human resource accounting. Friends, this particular accounting has emerged in the recent past and therefore something new is always welcome. Though sometimes there are certain resistance, but then it is temporary. Once you make them understand that it's good for you, you can always manage your ship. So approaches to human resource accountability. Accountability. Let us just understand. Accountability. So HR management by objectives, MBO. As per this technique, the HR department develops specific objectives. These objectives are developed based on the expectation of the management regarding targets of various functional parameters. These targets are perceived to be necessary to achieve an adequate level of performance. Employee attitude survey. This technique is used to evaluate the effectiveness of HR department. It is used to understand the link between the employee attitude and organizational performance. HR auditing. An audit is an investigative, analytic, and comparative exercise to gauge the effectiveness of the method and processes involved in the accomplishing of a particular task. HR audit is undertaken to measure the effectiveness of the HR function. HR audit involves a systematic search leading to the gathering, compiling, and analyzing data for a specified period of time. HR case studies. Now, another approach is to measure and evaluate the impact of HR programs. Intervention is the case study approach. In this approach, the success of standalone programs, policies, practices, or HR intervention is examined, evaluated, and documented. These results are presented to the selected audiences and key managers. Definitely, HR is a cost-bearing activity. So HR cost-bearing, cost monitoring. HR managers generally use salary and perquisite expenses as HR cost. But there is a lack of understanding of how a change of HR practice can lead to a change in the cost structure of human resource. What does it mean? That suppose you just change any HR practice, suppose you give dual charge, definitely the cost structure will also be affected. One approach to evaluating HR performance and with reference to the cost is to develop cost standards, compare them with the actual cost incurred. Now, once you are comparing the actual cost with the internal cost standards, may not be that effective as comparing to the actual cost with similar external organization. See, internally you may be having the standard, but once you are just say comparing with the external organization, it becomes more authentic. Competitive benchmarking. Benchmarking is one of the strategies used in the quality movement, and a few of the pioneers in benchmarking were Xerox, Motorola, Kodak, and Texas Instruments. In the context of HR function, benchmark is applied by developing key measures that represent the output of HR function. Benchmarking can be used to modify and improve internal process, leading to enhancement in quality and cost reduction. So benchmarking is a continuous learning process with an intended outcome of improvement in overall HR effectiveness. HR effectiveness index. Once we just come to do what? So what we do, we are just checking the effectiveness of it, where we just see the HR effectiveness index is a single composite index whose constituents are various HR variables that impact organizational performance. The basic principle governing the construction of HR effectiveness index is to combine various variables receiving different weights according to their significance in organizational performance. The constants were based on plant specific factors. Human resource accounting as management decision tool. HR information in the financial form HRA formation influences the corporate investors' decisions, whereas HR information in the non-financial form has considerably lesser influence. HRA information is relevant and influences optimal investment decision and often input for HRA, the original cost method. If you just look at the human resource planning, the next topic, human resource planning is the process of acquisition, utilization, improvement, and preservation of human resources of an organization. From a strategic perspective, HRP is defined as the process by which management determines how an organization should make from its current manpower position to the desired manpower position. Performance management system. Performance. So the PMS is a systematic approach to measure and manage employees' performance in the light of the predetermined organizational goals. What it does, PMS is used to support decisions in the area of training, career development, and layoffs. PMS process starts with setting clear and specific performance expectation. Next, the achievement are measured, followed by formal and informal feedback. The main elements of PMS is the measurement process, and HRA provides the input for the measurement process. The various categories of human resource investment are cost associated with recruitment, hiring, orientation, training, and integration with the existing workforce. These estimated costs provide input to estimate the replacement cost of workforce at various levels. And this estimate of replacement cost goes into the planning of workforce acquisition. Composition management system. Composition management system is the process of establishment and implementation of policies, programs, and practices that determine the salary, incentives, and benefits each employee receives. A good composition management system should follow a systematic and scientific approach that should result in a fair, equitable, and logical composition. Information from HRA can be used by the salary administrators, through which they can design the salary structure in a fair, objective, and transparent way. Human resource accounting measurement models. The information regarding the value of human resource is a key input for managerial decision making and internal assess management. Apart from this, the information is used by investors, creditors, financiers, and government agencies for their purpose. Various approaches developed for measuring the value of human resource factors in nature and the use of such data method to account for human resource value are classified into the following categories: methods based on cost and method based on value. Cost means you have incurred on different steps. Value, that how much value you are adding by invoking such cost. So these are methods based on the cost. In accounting, the term cost is used in varied terms, including the historical cost, replacement cost, current cost, direct and indirect cost, fixed and variable cost, and standard cost. So here we are just looking at the historical cost, recruitment, selection, hiring, placement. It is the acquisition cost. Once the person is recruited, the formal training, on-site job training, special training is the cost of training, development cost. Development program, welfare and amenities inside the organization are going towards the welfare cost. And then welfare and amenities outside the organization, health of workers, safety of workers, welfare of workers, all these things are other costs. So once we just take the say combination of all these, it becomes historical cost approach. Replacement cost approach. This approach was propounded by Rensis Likert and further developed by Eric C. Flamehose. Based on the concept of replacement cost, this method can be used as an alternative or as supplement to the historical cost. Replacement. This method involves the measurement of cost to replace the firm's existing human resource to find the value of the existing human resource. Suppose an employee leaves the organization, then what would be the next cost you are going to incur? Is covered under the replacement cost approach. Because again, you have to just start from the scratch, taking the acquisition, the development, the welfare of the new employee. Opportunity cost method. Hakimiya and Jones proposed this method of human resource accounting to arrive at human resource valuation. In this method, different divisions are involved in a competitive bidding process for scarce employee. The bids are based on the perceived value of the employee and their utility to the division. The successful bid price is the value of that particular human resource, and the bid price becomes the part of the investment base. Opportunity cost. Standard cost. This method was suggested by David Watson. In this method, standard annual cost of recruitment, hiring, training, and developing the employees in particular is taken into consideration to calculate the value of human resource. The total standard cost for all employees is the value of the human resource. Value-based model. Now value, instead of just going for certain cost measures, you are going now for the value-based models. Lev Schwartz, the present value of future earning model, is giving you about the employee that what is the present value you are just giving would be your future earning as well. Flamhorse stochastic rewards valuation. Now, the reward valuation is something like a sort of motivational theory, motivational model, where you are giving them regard to those who are good workers. Present value of net benefits obtained, Morse model, where you are just giving them the information about the benefits to the employees by which they are motivated or otherwise. Hermanson's unpurchased goodwill method. Now there is a goodwill of the organization by which the employee is willing to stick or otherwise. This is the last unit of this particular course, the forensic accounting. In the forensic, because it is based on the detection of the fraud, so an overview of the fraud we have to just look at. In order to get the general understanding of fraud, let us have a look at the finding of the report to the nations 2020, published by the Association of Certified Fraud Examiners. In the study, they examined 2,504 fraud cases from 125 countries. These fraud cases had caused a total loss of more than $3.6 billion US dollars. A typical fraud case lasts for 14 months before being detected and caused a loss of 8,300 US dollars per month. It is estimated that organizations lose 5% of the revenue to fraud each year. It is a tentative thing or a sort of the collection and calculation also of the data. With a median loss of 1,25,000 US dollars per case and average loss of 15 lakh 9,000 per case US dollars. Fraud triangle. See how the fraud takes place. What are the bases? What are the factors which are just influencing these frauds? The first one is incentive and pressure. That is need. Next is the opportunity they get. Third is rationalization and the attitude. See how this fraud is surrounded by these components. Major corporate fraud we had in the Satyam computer. This fraud is comprised of two parts. One is showing inflated revenue and the second one is showing inflated cash balances with the bank. Kingfisher Airlines, the fall of the airline started with the company borrowing huge funds from the bank and related parties. The collateral for this borrowing was Kingfisher brand. In the India's financial history, it was probably the first time when the banks had considered the intangible asset as collateral. Jet Airways, they have started doing overstating commission to be paid to the related parties based in Dubai, resulting in overstatement of expenses and underreporting of profits. Diversion of funds by giving loans of around 3353 crores, accounting of fake invoices, and this has led to the lenders when the lessors of aircraft they were not in position to make the payment. Bhushan Steel, they had a sort of transfer of borrowed funds to various related parties by way of loans and advances. They have taken the loan and once again they have given to the other party. According to capital expenses, they were never incurred misappropriation of these funds. PNB fraud, two diamond traders defrauded the PNB to the tune of 16,000 crores. Both of them imported rough diamond and exported polished diamonds. It was through an LC which was without any underlying transaction. It was never entered in the RTGS system of the bank, therefore evaded the reconciliation process of matching LCs with the actual transaction. Types of fraud, how it comes out to be. It could be cash, it could be assets, it could be, say, the transaction, it could be the disbursement, it could be the payroll, it could be the billing system, it could be in the papers. Method of fraud detection. Once you are just in know of that supervised method, fraud detection is based on the dynamics of the previous fraud committed. And once we are having the unsupervised methods, these are based on the identification of the outliers, which are detected through data mining techniques. So what are the forensic audit techniques? Testing internal controls. You are looking at the trend. If there is a deviation in the trend, definitely there must be some dislocation. Digital forensic examination, face-to-face interview, full financial audit because it is in the financial impacted transactions, application of Benford law, which is a mathematical tool to determine whether the variable under study is a case of unintentional error or fraud. Theory of relative size factors, whether unusual fluctuations are there, computer assisted auditing tools, whether you assess certain abnormality, data analysis ratios, where you just come to know about that this particular financial health is not as per the standard. And finally, it is Beneath ratios, which is distinguish between the fraudulent financial reports and non-manipulated financial reports. Once you compare these two, you just come to know that there are some dislocation in the fraudulent financial reports. Friends, with that, we have completed our MMPC 004 accounting for managers. We had 6 sessions in the past 5 weeks and today, and with that, we have covered one of the course of management program. Thank you so much for every support by the COE and Regional Center Noida. Namaskar.